Brad Williams, Frugal Finance, risk parameters and estimating CAPM. The last set of information we need to put risk and return models to use are the risk factors for individual investments and projects. In the CAPM, the beta of the asset has to be estimated relative to the market portfolio. Standard procedures for estimating CAPM parameters, betas, and alphas. To set up the general approach for calculating the beta in the CAPM, let's review the equation it provides for the expected return on an investment, R of J, as a measure of the investment beta investment, B of J, risk-free, R of F, and the market portfolio expected return. This formula can be written as follows: and excess return, R of J minus R of F equals B of J, R of M, or as raw returns, R of J, etc. These equations provide the templates for the two general approaches for estimating the beta of an investment using past returns. In the first, we calculate the returns generated by an investment in a specific market index over previous timelines in excess of the risk-free rate in each of the lines and regress the excessive returns on the investment against the excess returns on the market. Remember, we're looking at historical data here. Is that the best approach? Well, I've discussed a number of different ways to create, find, manufacture the beta. It's up to you. I'm a fan of the bottom-up beta. You may be a fan of something else. So be it. Jensen's alpha, this is the difference between the actual return on an investment and the return you would have expected to make during a past period, given what the market did and the investment's beta. In the second, we compute the historical raw returns before risk-free rate adjustments of an investment and the market index, and we regress the investment raw returns against the market's raw returns. R of J is equal this. The slope of the regression in each case indicate the stock's beta and its level of risk. In each regression, the intercept is a straightforward indicator of how the stock price performed in relationship to the CAPM expectations. Its interpretations vary slightly, though. In the excess return regression, the intercept should be 0 if the stock did exactly as predicted by the CAPM, and a positive or negative intercept can be viewed as a measure that the stock did better or worse than expected, at least during the period of the regression. In the raw return regression, the intercept has to be compared to the predicted intercept, R of F, 1 minus beta in the CAPM equation. If Jensen's alpha is greater than R of F, stock did better than expected during regression period. If alpha Jensen is equal to, stock did as well, and then if alpha Jensen is less, stock did worse. This measure of stock performance here, alpha Jensen in excess return regression, and here is called Jensen's alpha and provides a measure of whether the asset in question under or outperformed the market after adjusting for risk during the period of the regression. R squared measures the proportion of the variability of a dependent variable that is explained by an independent variable or variables in a regression. The third output generated from the regression is the R squared of the regression. Although the statistical reasoning of the R squared is that it suggests a measure of the goodness of fit in a regression, the financial basis for the R squared is that it provides an estimate of the proportion of the risk, the variance, of a firm that can be attributed to market risk. The balance, 1 minus R squared, can then be attributed to firm-specific risk. The last statistic worth mentioning is the standard error of the beta estimate. The slope of the regression, like any statistical calculation, is estimated with error, and the standard error exposes just how noisy the estimate is. The standard error, S of E, can also be used to derive at a confidence interval or the true beta value from the slope estimate. Since it allows for changes in risk-free rates from period to period, the basic return approach is easier to put into practice simply because we need only the average risk-free rate over the regression period. Estimation issues, There are three choices the analyst must decide when setting up the regression described. The first involves the length of the estimation period. The trade-off is straightforward. A longer timeline provides more data, but the company itself might have changed its risk characteristics over that timeline. Granite Construction and Amazon have changed significantly in regards to both business mix and financial leverage over the past few years, and any regression that we run using past data will be exaggerated by these changes. The second estimation problem relates to the return period. Returns on stocks are available on annual, monthly, weekly, daily, and even intraday basis. Using daily or intraday returns will boost the number of observations in the regression, but exposes the estimation process to a considerable bias in beta estimates linked to non-trading. For instance, the beta is estimated for small firms, which are more prone to suffer from non-trading, are biased downward when daily returns are used. Using weekly or monthly returns can lower the non-trading bias a lot. The third estimation problem is what market index do we use in the regression? Since we are estimating the betas for the capital asset pricing model, the index that we are using, at least in theory, should be the market portfolio, including all traded assets in the market held in relationship to their market values. While such a market portfolio may not exist today, the closer the preferred index comes to this model, more important the beta estimate should be. Therefore, we should push away from limited indices, Dow 30, sector indices, or the NASDAQ, and towards larger and wider indices, and away from equally weighted indices to value-weighted indices. It should be no shock that the most commonly used market index by beta estimation services in the U.S. is the S&P 500. It may consist of only 500 stocks, but since they signify the leading market capitalization companies in the market, held in proportion to the market value, it does embody a notable percentage of the market portfolio, but only if we identify it narrowly as U.S. equities. As asset classes multiply and global markets get bigger, we have to think about how best to broaden the index we use to reflect these excluded risky assets. Estimating CAPM parameters for Granite Construction. To evaluate how Granite Construction performed as an investment between June 2015 and July 2021, and how risky it is, we regressed monthly raw returns on Granite Construction against returns on the S&P 500 between this timeline. The return on Granite Construction and the S&P index are computed as follows. The return to the stockholder in Granite Construction are computed month by month from June 2015 to July 2021. These returns include both dividends and price appreciation and are defined as follows. Return Granite Construction equals price of Granite Construction minus price of Granite Construction at certain period plus dividends divided by price minus 1. Where price Granite J is the price of Granite stock at the end of the month J, and dividend Granite Construction J are dividends of Granite Construction in month J. Note that Granite Construction pays dividends quarterly, and that dividends are added to the returns of the month in which stocks went ex dividend. The level of the index at the end of the month and the monthly dividends yields on the index stocks are used to calculate the returns on the S&P 500 for each month over the same time period. Market return S&P 500 equals index J minus 1 plus dividends divided by index J of 1, where index is the level of the index at the end of the month J, and dividend J is the dividend paid on stocks in the index in month J. Since the S&P 500 is the most popular and widely used index for U.S. stocks, they are, at best, weak proxies for the market portfolio in the CAPM, which ought to include all traded assets. Images, this is the monthly return on Granite Construction against the S&P 500. The regression statistic for Granite Construction are as follows. The slope of the regression equals 1.4 right here. This is Granite Construction's beta based on returns from 2015 to 2021. A different beta may result from using a different regression time period or different return intervals, weekly or daily, for the same period. Intercept of the regression is equal to 0.052%. This is the measure of Granite Construction performance, but only when it is compared with R of F 1 minus B. Since we are looking at an investment made in the past, the monthly risk-free rate, because the returns used in the regression are monthly returns between 2015 and 21, averaged 1.02%, resulting in the following estimate for performance. Negative 0.408. Intercept, R of J 1 minus beta is equal to 0.52 minus 0.00408 equals negative 0.00516. The analysis suggests that Granite Construction stock performed 0.00516% worse than expected when expectations are based on the CAPM on a monthly basis between June 2015 and July 2021. This result is an annualized excess return of approximately negative 0.68%. Annualized excess return equals 1 plus monthly excess return 12 minus 1 equals 6.02. By this measure of performance, Granite did worse than expected during the period of the regression given its beta and the market's performance over this period. Note, however, that this does not say that Granite might be a good investment looking forward. It also does not give an analysis of how much of the excess return can be attributed to industry-wide results and how much is specific to the firm. To make that breakdown, the excess return would have to be calculated over the same period for other companies in the engineering and construction industry and computed and compared with Granite's returns. The difference would be attributable to firm-specific events. In this case, for example, the average annualized excess returns on other engineering and construction firms between 2015 and 21 was negative 13%. This would imply that Granite Construction stock outperformed its peer group by 18.66% between 15 and 21 after adjusting for risk. Firm-specific risk equals 5.62 minus negative 13.04 equals 18.66. R squared on the regression equals 28%. The statistics implies that 20% of the risk in Granite Construction comes from market sources, interest rate risk, inflation risk, etc., and that the rest, 72% of the risk, comes from firm-specific events. The latter risk should be diversifiable and, for that reason, unrewarded. Granite Construction R squared is somewhat higher than the median R squared of U.S. companies against the S&P, which is roughly 24% in 2021. Standard error of beta estimate equals 0.04. This statistic suggests that the real beta for Granite Construction could span from 1.36 to 1.44, subtracting or adding one standard error to the beta estimate of 1.41 with 66% confidence, and from 1.32 to 1.48, subtracting or adding two standard errors to the beta estimate of 1.4 with 95% confidence. These ranges may seem big, but they are extraordinary for most U.S. companies. This suggests that we should judge regression estimates of betas from a regression with concerns. Determinants of beta. The beta of a company is determined by three inputs: the type of business or business the firm is in, the degree of operating leverage in the firm, and the firm's financial leverage. Types of business: the more sensitive a company is to market conditions, the higher its beta, as beta measure a company's risk in relation to a market index. Therefore, it is reasonable to anticipate the cyclical firms will have higher betas than non-cyclical firms, all other things being equal. If everything else stays the same, business in the housing and auto industry, two highly sensitive economic sectors, will have higher betas than business in the food processing and cigarette industry, which are typically less sensitive to business cycles. Building on this point, we would also reason that the degree to which a product's purchase is or is not necessary, discretionary or not, will change the beta of the company making the product. The betas of discount retailers such as Target should be lower than the betas of high-end specialty retailers such as Ferrari or Louis Vuitton, since the shoppers can hold off the purchase of the latter product during economic time. It is true that businesses have very little control over how optional a given good or service is for their clients. Some companies, however, have made the most of this restricted control to reduce the discretionary nature of their product for consumers and consequently their economic risk. One approach is to make the product or service a much more integral and necessary part of everyday life, thus making its purchase more of a requirement. The second approach is to effectively use advertising and marketing to build brand loyalty. The objective in good advertising, as we see it, is to make discretionary products or services seem like necessities to the target audience. Thus, corporate strategy, advertising, and marketing can, at the margin, alter business risk and betas over time. Cyclical firms. A cyclical firm has revenues and operating income that tend to move strongly with the economy, up when the economy is doing well and down during recessions. Operating leverage, a measure of the percentage of a company's operating costs that are fixed costs. The relationship between fixed expenses and total costs is typically used to quantify the degree of operating leverage, which is dependent on a company's cost structure. Operational income variability is higher for a company with high operational leverage, high fixed expenses compared to total costs, than it is for a company with low operating leverage that produces a comparable product. For a company with significant operating leverage, a greater beta will result from a higher fluctuation in operating income. Even though operating leverage influences betas, because fixed and variable costs are frequently included in an income statement, it is challenging to gauge a company's operating leverage, at least externally. By examining changes in operating income as a function of changes in sales, one can obtain an approximate estimate of a company's operating leverage. The degree of operating leverage is equal to percentage change in operating profit divided by change in sales. For firms with high operating leverage, operating income should change more than proportionately when sales change, increasing when sales increase and decreasing when sales decline. Can firms change their operating leverage? Although some of a firm's cost structure is determined by the business it is in, a solar energy utility has to build costly solar plants and car companies have to build expensive plants. Companies in the U.S. have become increasingly creative in lowering fixed costs in their total expenses. Labor contracts that emphasize flexibility and allow the firm to make its labor costs more sensitive to financial success. Joint venture agreements where the fixed costs are borne by someone else, and subcontracting of manufacturing, which reduces the need for expensive plant and equipment, are only some of the manifestations of this phenomena. The argument for such action may be couched in terms of competitive advantages and cost flexibility, but they do reduce the operating leverage of the firm and exposure to marketing risk. Measuring operating leverage for Granite Construction. In Worksheet 211, we estimate the degree of operating leverage for Granite Construction from 2011 to July 2021 using earnings before interest and taxes as the measure of operating income. The degree of operating leverage can adjust radically from year to year due to year-to-year movements in operating income. Working with the average changes in sales and operating income over the period allows us to calculate the operating leverage at Granite Construction. Operating leverage equals percentage change in EBIT over percentage change in sales, negative 49.2. There are two important comments that we can make about Granite Construction over the period. First, the operating leverage for Granite Construction is lower than the operating leverage for other engineering construction firms, which we computed to be 1.15. This would mean that Granite Construction has lower fixed costs than its competitors. Second, the acquisition of Lane Water by Granite Construction in 2018 may be affecting the operating leverage. Looking at the numbers since 2015, we get a higher estimate of operating leverage equals 1.18. We won't read too much into these numbers because Granite Construction has such a wide range of businesses. We would assume that Granite Construction material business has higher fixed costs and operating leverage than its transportation. Degree of financial leverage. An increase in financial leverage will generally increase the equity beta of a firm. Normally, we would think that the fixed interest payments on debt to enhance earnings per share in good times and to drive it lower in bad times. Higher leverage amplifies the variance in earnings per share and makes equity investments in the firm riskier. If all the firm's risk is borne by the stockholder, i.e. the beta of debt is zero and debt creates a tax benefit to the firm, then beta is equal to beta U 1 plus, looks like we're looking for a total beta here. Beta, leveraged beta for equity in the firm, unlevered beta, marginal tax return, debt to equity ratio. The marginal tax rate is the tax rate on the last dollar of income generated by the company, and usually will not be equal to the effective or average rates. It is used because interest expenses save taxes on the marginal income. Intuitively, we see that as leverage increases as calculated by the debt to equity ratio, equity investors bear higher levels of market risk in the company, leading to higher betas. The tax variable in the example captures the benefit generated by the tax deductibility of interest payments. The unlevered beta of a company is identified by the kinds of business in which it operates and its operating leverage. This unlevered beta is sometimes defined as the asset beta because its value is recognized by assets owned by the company. Consequently, the equity beta of a company is determined both by the riskiness of the business it operates as well as the amount of financial leverage risk it has taken on. Because financial leverage multiplies the underlying business risk, it stands to reason that companies with elevated business risk should be hesitant to take on financial leverage. It stands to reason that companies operating in somewhat established businesses should be better prepared to take on financial leverage. Utilities, for example, have traditionally maintained high debt ratios, but not high betas, mostly because their fundamental businesses have been well established and are rather predictable. Breaking it down into pieces, business and financial leverage, and give us some insight into why companies have high betas. Those companies with high betas generally operate in a risky business, or they take on too much financial leverage in a relatively stable business. The smaller high growth firms have high betas than larger and more mature firms. Though the answer might appear apparent at first glance that smaller, higher growth companies are riskier than larger firms, it is not a simple question to answer. If the question were posed in terms of total risk, smaller and high growth companies will generally be riskier simply because they have more unstable earnings and their market prices show it. When it is identified in terms of betas or market risk, smaller and higher growth firms should have higher betas only if the products or service they offer are more discretionary to their customers or they have higher operating leverage. It is also likely that smaller companies might operate in smaller niche markets and sell products that customers can typically delay or defer buying, and that the absence of economies of scale lead to elevated fixed costs for those companies. These companies should have higher betas than their larger counterparts. It is also sensible that neither condition holds for particularly small companies. Effects of financial leverage on betas. From the regression from the period 2015 to 21, Granite Construction had a beta 1.4. To estimate the effects on financial leverage on Granite Construction, we begin by estimating the average debt to equity ratio between 15 and 21 using market values for debt and equity. Average market debt to equity ratio between 15 and 21 is 35.76. The unlevered beta is estimated using a marginal corporate tax rate of 25%. Unlevered beta is equal to 1.10. We take 1.4, divide this by 1 plus 1 minus the tax rate times 0.357, which is this operating leverage. Here, the leverage beta at different levels of debt can then be shown as under here, right here. And unlevered beta equals this. So for instance, if Granite Construction were to increase its debt equity ratio to 10%, its equity beta will be 1.18%. If the debt equity ratio were raised to 25%, the equity beta would be levered beta, so it would be run up to 1.31. So here we go. The bottom line here is there's an optimum we can generate to determine what that optimum debt level is, but you can see the cost. As your leverage increases, your beta is going to increase, your risk is going to skyrocket. As Granite Construction's financial leverage increases, the beta increases concurrently. Crunch the numbers, they're pretty straightforward. The logic is pretty straightforward. And if you really want to get deep into the weeds, check out the general contractors pages. You're going to see on one of the pages that there's a way to compute the optimum debt level. It takes too much time to explain. I'm not going to explain it. I left it there strictly for meat, but if your intuition says, I think I can figure this out, then work it out. It's pretty straightforward. Just keep in mind, there's a circular reference issue related to the computation, and you go to File, Options, make sure you enable this, okay? Otherwise, you're going to run into a circular problem, and it says you have a circular problem, blah, blah, blah. That's not a problem. It's part of the solution. It has to be turned on, otherwise it won't work. Brad Williams, Frugal Finance. Thanks for watching.